Stocks, gold, forex, derivatives. Opening a retail trading app today means facing a wall of flashing numbers and dense terminology. The experience feels like a fast-moving, high-stakes environment designed to keep you guessing. Beneath that noise, every financial tool follows a strict, highly organized structure. This system operates on a specific set of rules that remain hidden until you look at the architecture behind the trades. This vertical flowchart illustrates how the financial system operates through a top-down hierarchy. Think of it as a hierarchy that categorizes every movement of money in the economy. At the top level, we have the super asset. That breaks down into a specific asset class, which gets packaged into a product, and finally becomes an instrument at the very bottom. When you tap buy on a share of a company like Reliance, you are interacting with the very bottom of this chain. That single share is the instrument. That one tap traces upward through the entire structure. The share belongs to an equity product, which sits within an asset class, which eventually feeds into a top-level super asset. The instrument on your screen is simply the visible surface of a massive structural matrix. There are only 3 super assets, and they dictate the purpose of every financial tool in existence. The first pillar is the underlying. These are independent, real-world assets that generate wealth. The second pillar contains derivatives. A derivative is a contract whose value is tied to an underlying asset. These function as insurance policies layered over real assets, shielding the owner from price swings. The third pillar is structured finance. This involves combining different assets together, a mechanism used by major banks to scale their operations. Every product exists to fulfill one of these goals: building wealth, protecting it, or packaging it for the market. This horizontal tree diagram maps out the underlying category, showing the 5 specific ways money moves through the global economy. First, we have money, which facilitates short-term lending. Next are bonds, which act as long-term loans issued by governments or corporations. The third branch is equity, the mechanism for owning a fractional piece of a company. The fourth is forex, where different national currencies are traded. Finally, commodities covers physical goods like gold, oil, or wheat. These 5 categories provide the raw materials for the financial system. They are the base engines of actual economic value. Holding physical assets carries risk. A farmer relying on a wheat harvest could see global prices drop, threatening their livelihood before the crop is harvested. This graph shows how a derivative manages that risk. By locking in a present-day price with a contract, the producer is shielded from future market volatility. While producers use derivatives to handle risk, massive institutions use securitization. This is the practice of pooling various types of debt and selling them as consolidated products to investors. In this diagram, banks take thousands of individual illiquid liabilities, like home mortgages, and compact them together into a single unified product that can be easily traded. This financial engineering serves a practical purpose: shifting risk away from producers and creating scalable debt systems for large institutions. Once these assets and products are created, they move into designated environments to be bought and sold. This model represents the primary market, a direct pipeline where a company sells initial ownership to investors, raising capital. This happens during an IPO, the first time shares are sold publicly. Once those shares are held by the public, they enter the secondary market. The company is removed and investors trade exclusively with one another. The daily fluctuations on a stock market ticker reflect only this secondary arena. The company's actual business operations remain detached from these retail trades. This flowchart reveals how the system connects. Every concept, from the 3 super asset pillars down to the 5 asset classes and the trading markets, fits into this single framework. Managing money effectively requires seeing how these individual pieces fit into the larger machine. When you understand the underlying structure, the jargon becomes irrelevant.